Of all the charges the ATO can impose, the general interest charge is the most insidious, not because it is the largest on day one, but because it never sleeps. It accrues daily, compounds relentlessly, and since July 2025 cannot even be deducted. A $50,000 tax debt, left unresolved for a few years, can quietly grow by tens of thousands more. I am Tin-Lok Shea, tax lawyer at Australian Tax Experts. In this presentation, we will pull apart how GIC works, the rate, the compounding, the change that made it more expensive, and then walk through every lever available to reduce it. Remission, the 50-50 arrangement, and properly structured payment plans. If you owe the ATO money, this is the interest bill we are talking about.
Four numbers tell the story. Around 11%, the current annual GIC rate, built from the 90-day bank bill rate plus a fixed uplift of 7 percentage points and reset every quarter. Daily, how often it compounds. Not monthly, not annually. Every single day. Interest is calculated on the interest. 0%. How much of it you can deduct since the 1st of July 2025. The full rate is now borne after tax for individuals and businesses alike, and $1.5 million. The GIC that accumulated in a single matter our office handled, where a $3.5 million assessment grew to nearly $5 million before resolution. Individually, each number is manageable. Together, they are a machine for growing debt.
Start by clearing up what GIC actually is. It is not a penalty. No misconduct is required, no breach, no bad behavior. GIC is simply the price of having an unpaid tax liability, full stop. It is automatic and completely indifferent to your circumstances. It runs from the day the tax was due until the day it is paid, whether you knew about the debt, were actively disputing it, or had entirely good reasons for the delay. No officer decides to impose it, it simply accrues. And it is deliberately expensive. The formula, the 90-day bank bill rate plus 7 full percentage points, is not designed to reflect commercial lending. It is designed to make the ATO the worst lender you have, so that no rational taxpayer chooses to finance their affairs by not paying tax. Understand that design, and every strategy that follows makes sense. Now the change that quietly repriced every tax debt in the country. From the 1st of July 2025, GIC and its cousin, the shortfall interest charge, is no longer tax deductible. For decades, the deduction softened the blow. A business paying 11% GIC effectively bore materially less after tax. That cushion is gone. For businesses that previously deducted their GIC, the effective borrowing cost rose by several percentage points overnight, with no announcement letter and no transition for existing debts continuing to accrue. But the change cuts the other way too, and this is the part to remember. Remission is now worth more than it has ever been. Every dollar of GIC the ATO remits is a full after-tax dollar back in your pocket, and remitted GIC does not come back in as assessable income. Carrying an ATO debt has never been more expensive. Reducing one has never been more valuable. Here is the snowball, step by step. It begins the day the tax falls due, not the day the ATO writes to you, not the day you notice. The clock starts at the due date, which is why old debts arrive with old interest already attached. From that day, interest accrues daily at just under 11% per annum. Small amounts at first, easy to ignore. Then the compounding takes over. Each day's interest is calculated on the original tax, plus every dollar of interest already accrued. Today's interest earns interest tomorrow, and given enough time, the debt outgrows the tax. On long-running matters, the GIC component can rival, or exceed, the original liability itself. Compounding is a wonderful force when it works for you. On a tax debt, it is working for the commissioner. Let me make the snowball concrete. Our office acted in a complex offshore matter, the kind of dispute that takes years to work through evidence, correspondence, and negotiation. The tax assessment itself was approximately $3.5 million. But while the substantive argument ground forward, the general interest charge did what it always does: accrued daily, compounded quietly, and kept climbing regardless of the merits. By the time the matter was finally resolved, accumulated GIC had pushed the total debt to nearly $5 million, almost $1.5 million of pure interest. The lesson is one every taxpayer in a long dispute needs to hear. The interest becomes the biggest number in the room, and it must be managed as actively as the tax itself. Which brings us to exactly how.
So what happens to GIC while you fight the underlying assessment? First, the uncomfortable truth. Objecting does not stop the clock. GIC keeps accruing on the assessed amount until an amended assessment issues, however strong your case, however unreasonable the ATO's position. But there is a practical mitigant every disputing taxpayer should know: the 50-50 arrangement. Pay at least half of the disputed amount, and two things follow. The ATO generally defers recovery action while the dispute runs, and if the dispute is ultimately decided against you, 50% of the GIC that accrued on the unpaid balance is remitted. You have halved your interest risk and bought peace from enforcement in a single step. And of course, if you win, the interest unwinds with the assessment. GIC attributable to the excess falls away. Manage the interest position from day one of the dispute, not at the end. Now to remission, the ATO's discretion to wipe GIC away in whole or in part. Be clear-eyed. The bar sits higher than for penalties, and the ATO will not remit interest simply because a debt is hard to pay. But three doors are genuinely open. First, ATO-caused delay, where the ATO's own actions or delays caused or contributed to the late payment. A misdirected letter, a stalled review, months of silence. The interest attributable to that delay is squarely arguable. Second, serious personal circumstances, illness, incapacity, or other exceptional situations beyond the taxpayer's control. And third, the general discretion, other special circumstances that make it fair and reasonable to remit. In practice, partial remission is the common outcome. But on a large debt, partial is still substantial. And here is what separates winners from losers. A submission that documents the circumstances and connects them explicitly to the ATO's published criteria measurably outperforms an unstructured plea. Remission is argued, not requested.
Where remission is not available, structure still helps, and that means a payment arrangement. Three things a properly negotiated plan achieves. First, enforcement is paused. While you comply with the arrangement, the ATO holds off its harder tools, garnishee notices on your bank accounts, charges over property, director penalty notices. That protection alone is worth having. Second, the snowball slows. Every repayment reduces the principal on which the daily interest is calculated, so the GIC accrual falls with each installment rather than compounding unchecked. And third, a point many taxpayers miss, the terms follow the preparation. A payment plan is not granted by phoning the ATO and asking nicely. It is priced on your financial information. Well-prepared financials and a credible proposal consistently secure longer terms and better treatment than an improvised phone call. Treat the negotiation like the commercial transaction it is.
Let us pull the levers together in order of impact. Lever 1. Resolve the principal fast. Nothing reduces GIC like eliminating the balance it accrues on. Payment, negotiated settlement or voluntary disclosure all beat drift, and every day of delay is a day of interest. Lever 2. Apply for remission properly. Documented circumstances connected to the ATO's published criteria, argued as a case. Lever 3. If you are in a dispute, use the 50-50 arrangement. Halve the interest risk and stop recovery action while the argument runs. And lever 4. Structure a payment plan for whatever remains, slowing the compounding and holding off enforcement while the debt is cleared. None of these levers is exotic. What they share is a simple requirement. Someone has to actually pull them. GIC is the cost of inaction, and every strategy against it begins with acting.
At Australian Tax Experts, tax lawyers and accountants manage tax debt as one team. We start with GIC exposure reviews, establishing exactly how much interest is accruing, at what rate, across which periods, and which of the levers we have discussed genuinely apply to your debt. We prepare remission applications, your circumstances documented and argued against the ATO's own criteria, in the structured form that decision-makers respond to. And we negotiate payment plans, arrangements built on properly presented financials, with enforcement held off and the compounding brought under control. If your ATO debt has been quietly growing in the background, the most expensive thing you can do is leave it there another quarter. The arithmetic only ever moves one way. If you have an ATO tax debt with general interest charge accumulating, contact Australian Tax Experts today. Acting earlier will always cost you less. Visit australiantaxexperts.com.au/contact for a confidential discussion of your options. Thanks for watching, and remember, this presentation is general information only, not personal tax or legal advice.